What you're witnessing right now is not just another market correction. This is the complete unraveling of a system that's been broken for decades. Today, February 2nd, 2026, silver ETFs have crashed up to 20% in a single session. And if you're holding paper silver, you need to understand something critical. Your investment may not be worth what you think it is. Welcome back to the channel. If this is your first time here, hit that subscribe button, because what I'm about to show you is information the mainstream financial media doesn't want you to know. Today we're exposing the greatest disconnect in precious metals history, a divide so profound it's threatening to tear apart the entire global silver market. Let me paint you the picture of absolute devastation that unfolded in silver markets today. Multiple silver ETFs locked in 20% lower circuit breakers on the National Stock Exchange. Edelweiss Silver ETF locked at the maximum downside limit. Kotak Silver ETF, DSP Silver ETF, Axis Silver ETF, Aditya Birla Sun Life Silver ETF, Grau Silver ETF, every single one of them plunged between 18.5% and 19.9% in a matter of hours. But here's where it gets absolutely insane. While these paper silver instruments were getting absolutely destroyed, something remarkable was happening on the other side of the world. Physical silver premiums in Shanghai and Dubai were surging to unprecedented levels. We're talking $20 premiums over Western spot prices. $20 per ounce. Think about what that means for a moment. Your ETF holdings are down 20% today, but if you actually tried to buy physical silver in Asia, you'd be paying massive premiums over the crashing paper price. This is the smoking gun that proves everything we've been warning you about. What we're witnessing is what analysts are calling the Great Divorce. The complete decoupling of paper silver from physical metal. For decades, Wall Street banks controlled silver prices through what I call financial fairy dust. Billions of dollars in paper contracts that rarely, if ever, resulted in actual physical delivery. Here's how the scam worked. COMEX and other futures exchanges allowed massive leverage. Traders could control 5,000-ounce silver contracts with minimal collateral. This created an artificial supply of paper silver that had absolutely nothing to do with real physical metal sitting in vaults. The system worked beautifully for the banks. They could suppress prices, manipulate markets, and profit from both sides of every trade. But in January 2026, the CME Group dropped a bomb. They instituted a percentage-based margin system, hiking maintenance margins to 15% for standard positions and up to 16.5% for heightened risk positions. This move effectively ended the era of cheap paper speculation and created what Peter Brandt called a margin trap. Sound familiar? It should. This is exactly what happened in 1980 when regulators busted the Hunt brothers' silver position by raising margin requirements. History doesn't repeat, but it sure as hell rhymes. The margin hikes triggered forced liquidations across the board. Highly leveraged speculators who were already tapped out couldn't meet the new requirements. They had to sell, which pushed prices lower, which triggered more margin calls, which forced more selling. It's a death spiral, and thousands of retail investors got caught in the meat grinder. Now here's where this story takes a turn that should terrify anyone holding paper silver. While COMEX was flashing red and ETFs were getting slaughtered, physical markets in Asia were telling a completely different story. Shanghai was trading silver at premiums of up to $20 over Western spot prices. Dubai markets showed similar massive premiums. The Shanghai Gold Exchange saw silver prices above $82 per ounce, while COMEX was sitting around $71 to $80. That's not a typo. We're talking about a $6 to $20 spread on a commodity where shipping costs are maybe $1 to $2 per ounce. In a functioning market, arbitrage opportunities like this disappear in seconds. Traders should be buying cheap on COMEX, shipping to Shanghai, selling at $85, and pocketing easy profits. But that's not happening. Why? Because there isn't enough physical metal to move. Think about the implications. Shanghai is willing to pay $20 premiums. Dubai is paying massive premiums. Physical silver lease rates in London are elevated and staying there. COMEX registered silver inventories have dropped by roughly 1/3 since September. These aren't just numbers on a screen. They're symptoms of a physical supply crisis that paper markets are completely ignoring. Let's talk about what's really happening with silver ETFs, because this is where retail investors are getting absolutely destroyed. When you buy shares of a silver ETF like SLV or any of the Indian silver ETFs that crashed today, you think you're buying silver. But what you're actually buying is a paper claim on silver that may or may not exist. Here's how the system is supposed to work. Authorized participants create ETF shares by depositing physical silver, and they can redeem shares by withdrawing physical silver. This mechanism is supposed to keep ETF prices aligned with physical silver prices. But when physical silver becomes scarce and lease rates rise, authorized participants become unwilling or unable to source metal for ETF creation or redemption. In these scenarios, and we're seeing this play out right now, ETFs can begin trading at persistent discounts to net asset value, suspend redemptions, or be forced into cash settlement. In an extreme squeeze, ETF shares may continue trading while the underlying metal effectively disappears from the market. You believe you own silver, but in reality, you hold a paper claim with growing counterparty risk. This is how paper markets break. Not through a single dramatic default, but through gradual loss of credibility, as physical metal flows out of Western vaults and into regions willing to pay real premiums. The AGQ ETF, a leveraged silver ETF, plunged 65% in a single session during the worst of the selling. 65% in one day. That's not a correction. That's a complete systemic failure of a financial instrument. Now let's address the elephant in the room. Why is paper silver crashing while physical demand is surging? The answer exposes everything wrong with modern financial markets. Silver is in its 6th consecutive year of supply deficits. Let me repeat that. 6 straight years where demand exceeds supply. Global mine production peaked around 2016 and has been declining since. Meanwhile, industrial demand has exploded. About 70% of silver is produced as a byproduct of base metal mining, which means higher prices alone can't quickly bring new supply online. You can't just decide to mine more silver when prices spike. You need new copper and zinc mines, which take years to develop. Industrial demand now consumes more than half of annual silver supply, and much of this demand is highly inelastic. Solar energy, electric vehicles, AI infrastructure, data centers, advanced electronics, they all require silver regardless of price. This metal is consumed and effectively removed from circulation. Unlike gold, which mostly sits in vaults and gets recycled, silver disappears into applications where it can never be recovered. China has locked down silver exports, creating panic among industrial buyers who actually need physical metal for next-generation solar and AI technologies. Facing persistent supply deficits, these buyers are no longer settling for cash. They need the actual metal, and they're willing to pay whatever it takes. This is why Shanghai premiums have exploded. This is why London lease rates are elevated. This is why COMEX inventories are plummeting. The real world is experiencing a physical shortage while paper markets pretend everything is fine. Here's a concept that most retail investors don't understand but absolutely should. Market structure. Specifically something called backwardation. Normally, commodity futures trade in contango, where future delivery dates cost more than immediate delivery. This makes sense because storing and financing metal costs money. But when a market flips into backwardation, where immediate delivery costs more than future delivery, it signals acute stress. It means people need metal now and are willing to pay a premium for immediate delivery. A year ago, London silver showed normal contango, $29 spot, rising to $42 in forward months. Today it shows $80 spot falling to $73 forward. The market has inverted. Meanwhile, COMEX paper still sits in lazy contango, pretending everything is fine. The one-year silver swap has gone deeply negative. Everyone wants physical silver. Nobody wants paper. This is the clearest signal that something fundamental has broken. 3 markets are now telling 3 completely different stories. COMEX paper says everything is fine, just normal commodity trading. London physical says we need metal now, and we'll pay premiums for it. Shanghai physical says we'll pay $10 to $20 premiums over COMEX because paper prices are fiction. When physical markets diverge from paper markets like this, history is absolutely clear. Paper eventually reprices to physical reality, not the other way around. Let's go back to those margin requirement changes, because this is the mechanism that's crushing retail investors right now. The CME didn't just raise margins, they engineered a trap that makes it nearly impossible for small speculators to survive. By moving to a 15% to 16.5% percentage-based system, they effectively ended the era where traders could control massive positions with small amounts of capital. When silver was at $30, you needed X amount to hold a contract. But as silver surged toward $120, that same percentage meant your margin requirements multiplied. Traders who were fully invested at lower prices suddenly found themselves massively undercapitalized as prices rose. Then when prices started falling, they got hit with the double whammy, falling prices triggering margin calls while also being unable to add capital because they were already maxed out. This created the perfect storm for forced liquidation. And make no mistake, this was intentional. The exchanges learned from 1980. They knew exactly what would happen when they raised margins during a parabolic move. They deliberately pulled the rug out from under retail speculators. Wall Street legends Peter Brandt and Marko Kolanovic both predicted this crash. Now, remarkably, both have flipped bullish after the washout. Brandt explicitly stated, 2026 is not 2011. I do believe there is more ahead for silver, but not until the hotshot know-it-all bulls are thoroughly washed out. Translation: the squeeze isn't over. This was just the shakeout before the next leg higher. Here's a statistic that should keep you awake at night. There are approximately 377 paper claims for every single ounce of physical silver in COMEX vaults. Think about what that means. If even a small percentage of paper holders demanded physical delivery, the entire system would collapse overnight. This fractional reserve system works beautifully until it doesn't. And right now, with Shanghai paying $20 premiums and industrial buyers desperate for physical metal, we're approaching the breaking point. ETF investors are particularly vulnerable. When you try to convert shares to physical metal, you'll discover there's not enough metal to go around. Some ETFs will suspend redemptions. Others will force cash settlement at depressed paper prices. Either way, you're trapped. China's control over global silver refining combined with export restrictions has created a perfect storm. When they tighten exports, companies that previously managed just-in-time inventory are now hoarding. Solar manufacturers need silver for photovoltaic cells. Electronics makers need it for circuits. EV manufacturers need it for batteries. AI data centers need it for servers. This industrial demand is price inelastic. A smartphone maker won't stop production because silver costs $80 instead of $30. This is why Shanghai premiums persist, and arbitrage isn't closing the gap. Western banks can sell paper silver, but Eastern industrial buyers need physical metal, and they'll pay premiums to get it. Let's get practical. If you're holding silver investments, here's what you need to understand. Physical silver holders, actual coins or bars in your possession, you're holding real assets while paper markets implode. Don't let today's paper price scare you out. The physical shortage is real. ETF holders, you need to seriously evaluate your position. Today's 20% crash could be the beginning of systemic breakdown. If you can't redeem for physical metal, you're holding counterparty risk disguised as silver. Considering buying the dip, understand what you're buying. Paper silver might seem like a bargain, but you're betting the system won't break. Physical silver, even at premiums, might be smarter if you believe the shortage narrative. Smart money watches Shanghai premiums, London lease rates, and COMEX inventories, not paper prices. These are your leading indicators. The silver market is experiencing a structural breakdown decades in the making. Paper prices crashing 20% while physical premiums surge $20 isn't normal, it's a system in crisis. We're watching paper silver's credibility collapse, while physical metal becomes unavailable at reasonable prices. ETF investors are trapped. Hold and hope or sell into a crashing market. The great divorce between paper and physical is accelerating dramatically. The margin trap has sprung. Eastern markets pay premiums. Western markets can't explain. Retail investors are discovering they don't own what they thought. This isn't financial advice whatsoever, but I can read market structure and recognize when something is broken. And something is broken. Smash that like button and subscribe for updates. Comment below. Physical silver, paper silver, or have you exited? I want to hear from you. The silver story is just getting started. Markets never sleep. Stay vigilant, stay informed, and understand the difference between paper claims and physical assets. This is your wake-up call. The paper silver emperor has no clothes.